Today's episode is brought to you by Create Engage, the digital marketing agency for the disruptive management consultancy. Digital marketing has moved forwards, but most consulting firms haven't. Many consulting firms still see their corporate blog as their sole digital marketing channel and find themselves frustrated when these blogs yield little, if any, results. For those consultancies that understand digital marketing, though, it can be a huge asset and help them achieve rapid business growth. In fact, at Create Engage, we've recently written a case study of one successful consulting firm that used digital marketing to help them grow over 400% in just 3 years. Having spent countless hours researching consulting firms and consulting leaders for this podcast, it became very clear that while some firms do digital marketing well, the vast majority of consulting firms struggle to leverage its power and don't know where to start. To help those of you who want to harness the power of digital marketing to grow your consulting business, but don't have the knowledge, capacity, or in-house capability to do so, I launched Create Engage, the first digital marketing agency for the management consulting industry. As former consultants ourselves, we understand the challenges that you face when it comes to delivering effective digital marketing that engages prospective clients and generates leads. Having worked in the industry, we understand consulting buyers, what resonates with them and what doesn't. This enables us to harness the latest in digital marketing in a way that aligns with your brand and your market positioning to attract the prospective clients that you're looking to target. We understand that each consultancy is unique and have a range of services to help you shape, implement, and sustain effective digital marketing strategies that deliver results, regardless of where you are on your digital marketing journey. If you would like to find out more about how Create Engage can help you use digital marketing to take your business to the next level, then send me an email at nick@createengage.co.uk or go to our website, createengage.co.uk, where you can download that free case study that breaks down the digital marketing strategies used by one successful consulting firm to help them grow over 400% in just 3 years and gives you the secrets they used so that you can apply them in your own firm. If you want to outpace your competitors and stand out in the crowded consulting market, then get in touch. We'd love to help you grow your business through digital marketing. Hi, and welcome to Climbing Consulting. Firstly, I really hope that you, your family, and colleagues are all safe and well at this difficult time. Today's episode is one that I recorded just under 2 months ago, and it's amazing how much the world has changed in that time. Now, for some of you listening today, this episode could possibly be the most valuable episode of Climbing Consulting that I have ever recorded. And while the topics we discuss may not be top of your list right now, the principles and advice that today's guest shares will certainly help you when we start to emerge from this current crisis. So, who is today's guest and what makes this episode such a valuable one? Well, today I speak to Paul Collins, founder and chairman of Equiteq, the leading M&A advisory firm for the consulting sector. Over the last 16 years, Equiteq has helped over 100 consulting businesses successfully realize value through a sale or inward investment, guiding them on what they need to do to set themselves up for sale and then helping them navigate the often challenging sales process itself. Paul's journey into the world of consulting M&A started with his own experience when he sold his consulting business, WCI, to private equity for $100 million in 2002. He saw firsthand how little support there was available for consulting firms in the current M&A market and decided to launch Equiteq to help fill that gap. In today's conversation, we go deep into the world of M&A and dig into everything you need to know if you are growing a consulting business with the view to sell it at some point in the future. Even if you're not, much of the advice that Paul shares is equally applicable for you and will help you build a stronger foundation from which to grow your firm. To give you an idea of what's to come, some of the topics we discussed today include what determines the valuation of a consulting business and how just some small adjustments to your operating model and to your business can have a huge impact on the ultimate valuation you receive, what you need to do to set your firm up for success from the outset, and those key functions that are often so overlooked in consulting that actually by establishing, you will have a much better chance of selling your business in the future and Paul's candid advice from his own experience on how to balance growing your business with maintaining a happy and healthy personal life. In an industry as broad and diverse as consulting, there's very few people who are known industry wide, people whose reputation precedes them and are known by firms big and small. Paul is one of those people. So, with the build up done, grab your notepad. I know you're going to want to take a ton of notes from this one. Find a comfortable chair, sit back, and enjoy my conversation with Paul Collins. Paul, welcome to the show.
Thank you very much. Good to be here.
So there's so much for us to talk about, and I will shortly ask you to introduce yourself. But I also, and I was really keen to find this out when you teased me on the emails we exchanged just before this around your holiday, because what is it you went to do? Extreme fly fishing. I know what fly fishing is, but you travelled halfway across the world to do this, and I just love, because I'm sure others would be curious, what is it?
Well, it's the fastest growing part of the fly fishing sport is something called saltwater fly fishing. And the great thing about saltwater fly fishing is that you do it in hot places as opposed to trout and salmon, which most people know about, which are done in cold places. And I'm a bit of a hothouse flower, really, right? I don't like going cold places. So when I heard about this about 20 odd years ago, I launched myself at it. And it's fishing it's very similar. They're game fish, just like trout and salmon. They're species that most people have never heard of. So bonefish, tarpon, giant trevally. The giant trevally probably is the most famous one because of the Blue Planet series with the image of the fish coming out of the water to take a bird mid-flight. That's a giant trevally, and that's what I fish for. In far-flung places like the Cook Islands I've just come back from, and the Seychelles and other nice parts of the world. So yeah, it's a great sport to do.
I'll be honest, I've never been that keen on the idea of fishing, but that's mainly because I see people on the side of the Thames or other rivers in the cold and the rain. And I know before this you were illuminating me on how people can fish while sitting in a tent, which will...
Yeah, I don't wish to demean those who sit in their bivvies and catch carp all day, right? But no, this is a very active sport. I have to train for it. I have to keep fit for it. And if those of you track your steps, then I average about 25,000 steps wading through water in often quite difficult circumstances to catch these fish. And they can win. They're big fish on the end of a very light fly rod, and there's usually lots of predators around who want to take the fish you're trying to catch as well. So it has its challenges, but it's great fun. It sounds like a phenomenal hobby, and one that I'm really keen to dig into if we have time. Sure.
But as we both know, there are tons of things that we want to touch on today. And I think before we dive into it, actually for those who maybe don't know you, it'd be great if you could give an overview of your background and how you got to where you are today.
Yeah, so try and make it quick because I always say it is I've had several careers, and I started off life being trained in engineering. My degree was in electronic engineering from Birmingham University. And I went from there into a graduate apprenticeship with Lucas Industries. And back then they were automotive and aerospace parts companies. And I joined the grad apprenticeship scheme for 18 months because, frankly, I had no idea what I wanted to do. And the great thing about that was that it got me around all of the different functions. So I got to see finance and marketing and sales and manufacturing, engineering. And I ended up at the end of that in the manufacturing engineering department. And at the very young age of about 21, 22, I had responsibility for the design and build of an entire manufacturing facility that was making something called the electronic control unit for back then, the Tornado aircraft, which became very famous because of its vertical takeoff capabilities. And if you've been to any air show, then you'll have seen one of these. And I had the job of building this facility, which was a fantastic responsibility and experience. But at the end of 3 years, I decided that even though I loved doing what I was doing, it wasn't the best place to get paid. So I answered a daily Thursday's Daily Telegraph was where, if you're an engineer, was where you got your jobs from. And there was a double-page spread with pictures of windsurfers and sailing boats with the title "Engineers on the South Coast." And I answered that, and it was IBM in their Havant plant, as was back then, and joined them as a manufacturing engineer, just about double my salary overnight, and ended up being responsible for liaising between the development departments, mostly in the USA, and bringing new products that were designed for manufacturing that I was involved in into manufacturing in Havant. And that was fantastic as well. But my really big break that led to where I am now was being awkward enough to challenge everything to do with their supply chain logistics in IBM. And I became a pain in the butt, I think, to my management. And they ended up sending me to this seminar in New York, and I was the only Brit in amongst 100 other sort of IBM staffers, listening to this guy called Dr. Richard Schoenberger, who just released a book called Japanese Manufacturing Techniques, 9 Steps to Simplicity. And this was the early JIT, just-in-time manufacturing material. And it was honestly like a religious experience for 2 days. At the end of the day, he'd undid everything I knew to be true about manufacturing. I remember the guy answering a question from a very snotty-nosed senior guy in IBM about manufacturing and saying that, he'd been doing this for 30 years. And Dick Schoenberger's response to that was, he said, it's been my experience that doing the wrong thing for 30 years can only produce a wrong outcome going forwards. And I just love that sort of thing. So it was real heretical stuff. But at the end of the second day, I was a zealot. I was absolutely an apostle of Schoenberger, and came back to the UK. And I got the job of running a just-in-time program for the UK in IBM, which again, at sort of 26 or something, whatever it was I was then, was an amazing thing to do. And they had a bottomless budget to send me around the world to learn about just-in-time. I managed to use Richard Schoenberger as a consultant, and I became an internal consultant in IBM, teaching everybody how to do just-in-time manufacturing. And this was in the sort of late 70s, early 80s, and frankly, there was virtually no one around in the UK that was doing JIT then. So I built up a really valuable knowledge base that I frankly thought I would never get a return on in IBM. And so left IBM, which at the time nobody did. It was kind of a job for life, and went to work for A.T. Kearney, who were about 30 people on a little office in Piccadilly at the time. And I did that to frankly, sorry ATK, to pick your brains about how to run a consulting business with the intention of setting my own up, which I did a year later. And that was the start of what became WCI. I originally called it JIT Technology, which was a really dumb thing to do, because a little later, JIT got a bit of a bad name for causing stockouts in various industries like the pharma industry, but changed the name to originally through World Class International, which was another big name and a bit ballsy when you're only one person. I think I used my auntie's address in Australia to get the international bit of the name to get it to work. But then eventually the marketing men came in, and we abbreviated it to WCI because it fitted on logos and things, and World Class International didn't. And started the business there. Wind forward 16 or 17 years, and we were 350 consultants before I left. I sold the business to private equity in 2002 for £50 million, made 11 millionaires in the business, which I'm very proud of. And I did okay, thank you. So it was a great thing. And then at the age of, I think it was 50, tried to retire, failed miserably, and then set up Equiteq. And no doubt we'll talk a lot more about Equiteq as we go on. But I started Equiteq because, frankly, I'd had lousy support from the investment banking and M&A community in WCI. And being the arrogant consultant that we often are, I thought I could do it better. And that's how Equiteq came about.
And you're quite right. We're going to spend a lot of time digging into Equiteq and what you do. And as I said before the show, I'm really keen, given all of your experience and the number of deals that you've done as a firm, to dig into that, because a lot of my listener base are consulting entrepreneurs, or people who want to become consulting entrepreneurs. And actually, I think, like you said, with Silicon Valley now, you hear a lot of the high level statistics of, it's sold for X times multiple or Y times revenue. But actually, I'm sure, and if it's not, it might be a much shorter podcast, but I'm sure nothing's that simple.
It's not. No.
But maybe just before we dive into that, actually, for those who haven't heard of Equiteq, and I know a lot in the industry have, but actually, if you were stopped by someone in the street and they said, what does Equiteq do?
Yeah.
What's your answer to that?
Well, we're a strange breed of management consulting and investment banking. So we've tried to blend those two skill sets because we do two things in essence. The majority of our clients are on a journey to a future transaction. It may be a 100% sale, it may be a partial sale, it may be a capital raise, but it's some means of redistributing the shares at some point in the future. And I'd say at any point in time, we have 200 or 300 clients who are in that category, in a journey to a future transaction. And we're providing either growth consulting activities to them, so we're helping optimize their growth towards a future transaction, or we're preparing them for an impending sale, which could be a few months in the future, it could be 1 or 2 years in the future. So that's one thing we do, which is the majority of the clients. the majority of the money is made in the business off the back of the transaction side. So we act typically as a sell-side advisor to companies who've decided they want to sell. And if you'd have asked me 5 years ago, I'd have said that we are almost exclusively sell-side advisors. What's happened in more recent years is that our name has become very well known out there in the marketplace for selling consulting firms. We've done over 100 deals now in the sector. And big buyers have got used to us knowing what's out there. I mean, out of the 70 or so people that are in Equiteq around the world, we have a team of half a dozen people who are run out of this office here in the UK that are out there looking for firms all the time that may be potential targets. And often that search activity is stimulated by a buyer. So a buyer comes to us, and it could be a big consulting firm, it could be an IT firm, increasingly media firms, because the market is consolidating, and it's sort of digital transformation, if you like, that's in the middle of that change, that's pulling together people who once had either pure management consulting or pure IT or pure media. That's being pulled together, and that's causing lots of M&A activities. So it could be any one of those buyer groups that come to us and say, can you find us a firm that looks like this shape? And we ought to know what those firms are, and so we'll produce a list for them. And occasionally we end up on the buy side in the transaction if it happens, but more often than not we still end up on the sell side. And most of the very sophisticated buyers out there are somewhat ambivalent as to which side of the fence we end up in the deal. The more important thing to them is that the deal gets done. And the sophisticated buyers would say, if our target acquisition isn't represented, then we're worried that the deal might not happen, that they're not serious. And if they've engaged someone like Equiteq, then there's a pretty good chance that the deal's going to happen.
I guess I'll start there because I want to come on to the mechanics and the sell side.
Yes.
I guess just intriguing there around what you said around the buy side and how you're almost being retained to search for these firms. And you made the point around the media companies is, I guess I've had a number of guests who have sold, the likes of Don Morehouse, it's public knowledge, used yourself. And actually, I know he sold to a media company. I think many people, I guess, imagine when they start this journey that the ultimate sell is going to be to one of the big four or big six.
Yeah.
And actually, this is my silly question, is almost, if you'd asked me, that would have been probably my starting point. But it sounds like there's a lot more out there, and almost who tends to buy consulting firms and why?
Yeah. So that's a really good question. It's not a silly one at all. And I think most people would think the way you think. But the reality is that often the best home and the best price for somebody who wants to sell their consulting business is not in one of their bigger competitors. And they'd be sorry to hear me say that, I'm sure. And, deals do happen with the big four and their lookalikes. But the best price is often where there is real synergy between the seller and the buyer. And if as a buyer, you're buying something that looks the same as you, then there isn't that synergy. It's almost like you're making a big recruiting effort and you're recruiting 30 or 40 or 50 people in one go, and that they look pretty much the same. And where the big firms tend to buy is where the consulting firm has a specialism that they don't have. So they're really into various sort of tech-enabled businesses these days. And as you already mentioned, right, they're big into buying media firms. And again, that's because there is synergy between what a media firm does and what a big consulting firm does. But if you're a pure play management consulting firm, then you're probably likely to get a better home. And I'll come back to what I mean by that in a moment. And certainly a better price by selling to somebody that's either in the media world or the IT world or in the general service world, or even frankly to a financial investor. And we'll come back to those later, because there can be interesting synergies there that you don't normally think about. People normally think that you have to sell to the trade, as it's called, i.e. another trading, consulting or IT business in order to get synergies. But financial buyers can provide those as well. And of course, there's potential other synergies to do with geography as well. And what I mean by the best home is that I wish I had £1 for every consulting firm owner that said to me, I'd love to sell my business, but of course we'd like to stay the same. Well, you sell to an Accenture or to a PwC, and you will look like Accenture or PwC within a few years. I mean, it may not happen overnight, and they'll tell you it's not going to happen. And I know with some of the media firms they've tried to make them look like the big four and have failed, and they've had to treat them differently because they're very different DNAs. But if you sell to somebody that's different to you, there's a reasonable chance that you actually might be left alone, and you may be building up or be a platform for building up a consulting capability that then will be used by either the marketing capability or the IT capability further down. And so there's a much bigger chance that you won't be stripped apart and split into the various different market sectors and geographies that might exist with one of the big four if you sell to those other firms. So yeah, it's definitely something that looks different, often produces more synergies, and that can play to price.
And just because I was noting down the different avenues you said there, and you made the point that actually that financial, and I'll let you explain what financial means, but that financial avenue can actually often be a lucrative one for a consulting owner, but also a less considered. Almost why to both of those? So why is it a good avenue, and why is it one that people tend to either not consider or maybe don't look at first?
So I think it's fair to say that the private equity community within the general category of financial investors has not done a great job at promoting itself. And so there are a number of clients that we come across who would say, we never ever want to sell to private equity. And I'll give you a specific on this. We represented Alpha Financial Markets Consulting some years back in their sale to Baird Capital. And I know they said to me when we first set off on that journey that there was no way they'd ever sell to private equity. And if I remember rightly, we produced about 8 trade buyers, all the big names that you might think of. And whilst they were produced all prices that were greater than their expectations, which was great, I think their response from the management team in total was, we can't imagine ourselves working for any one of those companies. Because in some cases, of course, they'd come from those companies, right? And you often get this sort of negative reaction that it feels like you're going backwards by going to your old employer, even though it's your firm that's selling to them. And I'd managed to snuck a private equity company into the list. And they said, but we really like the sound of that private equity company. Can you go find some more? Well, 3 or 4 months later, we had another 7 or 8 on the table, and they ended up selling to Baird Capital very successfully. And so, first of all, there's a trend in consulting firms selling more to private equity than they ever did in the past. It's definitely a trend. And if you look at our most recent deal activity of the last 3 or 4 years, then something like 40% of our deal activity has been with financial buyers. And I think there's a really good reason to this. And I frankly, 10 or 15 years ago, I wouldn't have said this because you may recall that WCI sold to a private equity company. And frankly, we didn't do a very good deal. And that was largely inexperience on my behalf and my team's behalf. We had a lousy M&A advisor who remained nameless, right, who didn't do a very good job. And we did a bad deal that wasn't even-handed. And if I wish I'd known then what I now know as Equiteq, right, we'd have done a much better deal. But the reason why increasingly private equity is a very good route is that the world of private equity has become much more even-handed in terms of the type of deal structure they put in place. So it's much more of a win-win deal. And secondly, if you look at the typical board of a consulting company that's grown over maybe 5, 10, 15 years, then quite often you find that it's made up of founders and other people in the management team that may have some equity now, but maybe have not got sufficient equity for it to be life-changing money. The founders may have that. And it may be that the motivation of the founders is to want to exit the company and take their money and go and spend it elsewhere. And if any wealth manager looked at them as individuals, they'd probably be saying, why have you got all of your assets in one asset class, which is your business? So it probably makes sense for them to de-risk that situation. But that might not be the case for the rest of the management team. So if you sold to PwC or Accenture or any of the big trade buyers, they typically only do 100% deals, right? And everybody gets treated the same way, right? So the founders may end up with a lot of money in their pocket and may in 2 or 3 years' time be able to leave the business. And by the way, rarely do people leave on day one. We can come back and talk about that if you want. But usually there's what's called an earn-out period, and that might be 2 or 3 years. But they may disappear off into the sun or to the beach at the end of that, the founders, whereas the management team is left in another business, now with not shares in their business, in some sort of remuneration plan, or maybe in some option scheme, or right, in a bigger company that might not suit what they thought they were going to get. And so you potentially get this conflict in the board of a company when it comes to sell if it's a 100% trade deal. Whereas private equity are much more flexible in the type of deal structure they do. They're quite happy with the idea of founders going off into the sun with all of their money, particularly if today they're not contributing anything to the ongoing growth of the business. And they recognize that it's the management team that's coming through that they need to incentivize with equity in order to get them to grow the firm during the tenure that the private equity company's there. And so it's in the PE's interest to get more shares into the hands of the management team. It's in the management team's interest to earn more equity and then make more out of the next 5 years worth of growth of the company. And if you add to that private equity will buy anywhere between a quarter of a firm and, let's say, 3/4 of a firm, and in some extreme cases 100% of the firm, then you can do very flexible deals at an individual shareholder level. And that's very attractive. And I think because they've become, let's say, more win-win partners with consulting firms, because they've recognized that in consulting firms, profits turn into cash quite quickly because there aren't any capital equipment or hard assets to invest the profits in, they can use very advantageous deal structuring that involves some debt when they make the purchase in the first place to make it very attractive for them to do a deal. And so the world of private equity really likes consulting firms now, and I believe it's a very, very useful home for companies to go to. So a long answer, but it's a very important point, this. And I would say, don't think negatively about the world of PE. The fact that their marketing isn't great doesn't mean that they are not great firms. They do a good job. And if you look at, the ownership of organizations globally, beyond consulting, you're seeing more and more private equity ownership for good reason, I think.
And I'm really glad I asked, and thank you for the in-depth answer as well, because it makes perfect sense when you explain it like that, and actually the win-win nature and the incentivization of the entire management team. Because I think when people think of selling a business, they think of that 100% transaction.
And there's a problem with the 100% transaction often. I mean, and you hear about this when it's really big deals, right? So when big brand name buys big brand name and it all goes wrong, it hits the papers. And you don't hear about some of the smaller ones because the names are not that well known, all right? But if the founders do take the money and go off into the sun and the management team end up as, middle management in one of these big firms, many of them don't like that. And so, it's not unusual for people to leave the big firm that's acquired in those situations, unless the big firm has done something very proactively to lock those people in place. And because they've got to fit, and it might be 50 or 100 or 200 people coming into many hundreds of thousands of people, often the flexibility isn't there to make sure the right incentives are put in place, right? So, partial deals and deals at an individual level can often work much better.
And so it may make the answer to the question I'm interested to move on to almost more difficult to answer or more nuanced. And I'm intrigued in that because, again, to the way I prefaced it at the start around multiple,
yes,
you hear, and I assume it's for simplicity, just this business sold for this multiple or that multiple. Yeah. And for listeners, and again, I'll play the sort of uninformed card on anyone's behalf, and certainly my own, of that makes a lot of sense in a 100% deal structure of almost, before going on to the mechanics of how you actually work that out. I'm intrigued by, does the model you've just explained add complexity? That if you're doing individual deals, I assume there is a base price that the firm is built off, but actually, how does that nuanced structure affect, or how does that multiple stakeholder and shareholder structure affect?
So that is a very nuanced question, right? And but let me try and answer it in a simple way. Whether it's a 100% trade deal or somebody's going to buy a percentage of a company, there's always a price worked out for the entire business. Yeah. And if you're selling 35% of the shares, let's say, for example, then you will receive 35% of the cash associated with that. And it might be cash immediately, or it might be cash over a period of time. But the 65% that's left will be shares in the new co that's created by the financial investor to do the purchase. So effectively, the structure is the financial investor creates a new company, a shell company, that buys 100% of the existing business. 35% of it might get distributed to shareholders now, and 65% of it are left in shares in NewCo. And then when you go down to the individual level, you might find that somebody is selling 60% of their shares, somebody's selling 100% of their shares, somebody might not be selling any shares at all. Depends on the individual requirements of the person, and of course the the financial investor have a say in that as well. So, if a founder that wasn't involved today didn't want to sell anything, they'd probably have something to say about that. If the current managing director who's responsible for driving everything wanted to sell everything, they'd have something to say about that as well. All right. So those are the two extremes. And of course, there are examples all in the middle. But so long as the average works out at 35% in that deal, then the financial investor is cool about it.
Well, let's come to what I imagine will be the simpler question to answer, which is the one that you teed me up nicely for in that answer, which is, how do you work out what a consulting business is worth? Is it simply a case of revenue? Is it profit? Or are there more nuances than that?
Yeah, there are lots of nuances. And you'll recall I said I was an engineer, right?
Yeah.
And as an engineer moving into the world of corporate finance, one of the first questions I asked when I started up Equiteq to a bunch of corporate financiers, and I had the good fortune for a couple of years in the early days of Equiteq. In fact, it's a bit like the JIT technology name. Equiteq used to be called Consulting Development. It says what it does on the can. And in those first couple of years, I worked typically for London-based consulting firms who wanted to sell their business and wanted someone to help them prepare for a sale. So I did 2 years of that. And whilst I was doing that, many of them were ready to go to market. And I ran the beauty parade on behalf of those companies to choose the M&A advisor, which is a horrible process and something that Equiteq has tried to avoid ever since. Right now, we come back to that later as to how we've done that. But part of that is to do with working with a company over a long period of time rather than just hanging around waiting for a founder to say, I want to sell, which is what most of our competitors do. So I was working for those companies, trying to prepare them for sale and then selling and seeing what the rest of the competition were doing, and had the opportunity to talk to all of them about how they valued a business. And if I talk to 6 firms, I get 6 different answers. And if you're an engineer, that can't possibly be right. So we built this piece of software, right, that has 80 key performance indicators that are linked to the valuation of your firm. Because to a certain extent, it felt like valuation was a bit of one of those accounting rear view mirror things that, you wonder quite how you arrive at that, all right? And you find out too late when you come to sell your firm. So we wanted some lead indications of future valuation, which is why we built this software. And we wanted the boards of companies to have a dashboard that they could focus on value creation, value building in the few years, well, actually from day one, in the years leading up to a potential future transaction. But in very simple terms, so very, very simply, if you had a business that had got flat revenue and profits over a number of years, then if you took the ability of that firm to generate free cash flow, and as I said earlier, in a consulting business, most of the profits end up in cash at some stage, and usually get distributed as bonuses or dividends or something like that if it's free cash. Well, of course, an investor is interested in a business's ability to create that free cash flow, because that's how they get a return for buying a business and buying the shares in a business. And so not surprisingly, it does have something to do with a company's ability to produce profit. And the term that you'll hear most frequently is in the UK, profit before interest, tax, depreciation, and amortization, or if you're in America, earnings before interest, et cetera, et cetera. So EBITDA or PBITDA is the point in the profit and loss statement that we tell people to focus on. And you'll hear people say that firms are bought on a multiple of EBITDA. And that's a bit of a shorthand, because buyers very rarely look at a business and say, I'll give you 5 times EBITDA. It doesn't work that way. What they do is they look at the history of the firm, they look at current performance, and they look at the forecast of the business. And in the Equiteq model, we look at a 6-year period. We go back 2 years, we look at current year, and we go out 3 years. And we say, what's the ability of the company to produce profits over that 6-year period of time? And if every year was the same, then you'd get an answer of 6 times EBITDA. Now, you really can't sell a business that's flatlined, all right? So this is not a real life situation, all right? It's almost impossible to sell a firm that's flat or declining, all right? You need a business that's growing. So growth is absolutely key to the valuation of any consulting firm. It's also the most important thing in generating the attraction of a buyer to you. And those things are different. There's the attraction of your business to a buyer, and then there's the price they're going to pay for it. And they're 2 very different things. And so if you're growing, if you can imagine growing over that 6-year period, and you add up the profits associated with those 6 years, then the chances are you'll end up with a bigger multiple of current year EBITDA. And so you'll hear in the press and in the reports that we produce every year about deals that have happened that some firms sell for 8 times EBITDA, 10 times EBITDA, and some of them maybe even translate that back to 1 times revenue or 2 times revenue. But those multiples of EBITDA and multiples of revenues are post-rationalized after the deal. And the reason why often people talk about revenue multiples is because it's easily accessible data. It's very difficult to get hold of real profit data in most privately owned companies. Even in public companies, it's sometimes quite difficult to interpret what the public data means. So people do often use revenue multiples as a shorthand, and somewhere between 1 and 2 times EBITDA revenue is a typical multiple that you might get for your business, and somewhere between 5 and 10 times EBITDA is what you might get, but it's just not calculated that way. It's calculated off the back of this period of time. We use 6 years. Some people use a different period of time. Some people don't go back at all. They look all future. Some people just look at the past and don't go far into the forward. So everybody's got a slightly different way of doing it. But it comes down to the company's ability to produce free cash flow is where the value is created. And of course, if you're looking at a 6-year period as we do, where 3 years are in the future, that's an estimate. We call it a forecast, don't we? And because it's a fancy name, we think it's real, right? But it's, in many companies, at best, it's a guesstimate, right? And the reason why we've got much more sophisticated on looking at other lead indicators of future profits is because we want to stick a hard line under the forecast of a company. Every buyer wants to push down the forecast. So if you're a seller and you're saying, this year I'm doing 10 million, next year I'm going to do 12, the year after I'm going to do 15, a buyer's going to say, oh yeah, pull the other one. Where's your evidence? And so they'll get very sophisticated conversations going on about your sales pipeline. And as we know in consulting, sales pipelines in terms of fixed orders very rarely go out more than a few months. So what you're going to sell next year and the year after is often, slightly more of an estimate. But you need to be able to show robustness in your firm, and that historically plans have equaled actual. And therefore, there's a chance that actuals should equal plan going forward. And here's all the other reasons, which are the other 80 KPIs, that makes you believe as a buyer that this is a very solid business and you are going to meet your forecasts.
I'm really keen, and if you can't share this because it's the proprietary part of the model, tell me. And don't worry, I'm not going to ask you to list all 80. Yeah. But actually, those lead indicators, because like you say, the first thing that comes to my mind when you talk about that forecasting is believability. Consultants are phenomenally good with Excel and can create very, very believable models. Yeah. But like you said, you've got to convince a buyer that it's going to play out. So if they do fall neatly into categories, what are those lead indicating groups, and almost the things that if someone listening to this is growing a consulting firm with a view to sell, they should be focusing on developing those areas to make sure those KPIs are as good as they can be?
This is an audio blog, right? So it's a bit difficult for you to see what I'm pushing in front of you, right? But this is one of our guides, right? Okay. That's been downloaded about 25,000 times off our website. And this is some of the intellectual property that goes behind those lead indicators of performance. And we call it the Equiteq growth wheel. It's broken down into 8 segments, and it starts at the top with market proposition. It goes around through sales and profit growth. It goes through client relationships, looks at quality of fee income, the annuity and repetitive nature of your income, if you have any. It looks at intellectual property in the business. It looks at sales and marketing processes, consultant loyalty, which is all about recruitment and retention. And then last but by no means least important, management quality. And a buyer is maybe not as rigorous and sophisticated, right, as we tend to be at looking at this, because we want this to be repeatable. We've done over 1,000 firms using this model with data that represents those 1,000 firms. And in each one of these 8 segments, there are about 8 to 10 questions that enable you to look at, assess, and then improve your performance against those indicators. And if you imagine this turned into a radar chart with 0 at the center and 10 on the outside, then you get a plot. And the area inside that plot has a direct relation to your multiple of profits when you sell. And that's how it works. It's incredibly powerful. It really works. And we've got lots of companies now that have sold off the back of this, where they've known the valuation they're going to be getting because they've worked on this model beforehand. And it becomes lingua franca in the company as to how every quarter, how they're building their valuation going forward.
Presumably, to your point around that radar chart,
yeah,
the closer to zero, either the lower the multiple or
yes.
the lower the chance of sale,
yes.
the closer to the 10 or whatever the top
yes.
figure is, the higher.
Exactly.
And just before I come on to digging into that, because I'm sure you sort of piqued my interest with you've had 1,000 firms go through, so I'd love to hear what some of the similarities are. That's available on your website, is it? So I'll put, for anyone listening, I'll put that link
absolutely.
in the show notes so they can get it. And to that point, and this might be the engineer in you, Paul, you've had 1,000 firms go through this. What are the areas that almost consistently you find firms are low in? And are there any in there that surprised you? They probably don't surprise you now, but almost as you analysed that data, you found surprising.
Yeah, I mean, there's lots. And what's been interested is trying to rationalise why. And I think it's something to do with, so we'll look at the why and then I'll tell you what they are. Because it's something to do with the way in which most consulting firms are founded, and they're often founded by people who work for one of the other big firms. So we were talking earlier about, I used to work for A.T. Kearney years ago. You were at Beringer, and many other people have come from one of the big four or their medium-sized lookalikes. And you join as a starry-eyed youngster, and you get straight out onto consulting on almost day one. In some of the better firms, you may have had a few months of training, all right? In the worst firms, all right, you're literally day one, you're out there consulting. And you're not exposed to anything else other than consulting in your subject matter until almost you become a partner and somebody says, here's the sales target. And suddenly you've got to go and find out how to sell, how to find clients. And you might be, for the first time, exposed to sales and marketing. You might not even know what it is. And I'm sort of making it an extreme point to make the point, right? But your knowledge of finance, your knowledge of sales, your knowledge of marketing, your knowledge of HR, et cetera, is probably quite small. And unless you've reached the heady heights of partner in those firms and you've had to perform a role about running those very large organizations and worked in amongst people who maybe have other functional backgrounds, you're pretty naive. And many people break out before they make partner, sometimes because they didn't make partner. They break out and they say, right, I'm going to run my own firm. I'm an expert in my subject matter. I'm a supply chain expert. I'm a costing expert. I'm a whatever expert. And you're very able to consult with clients. What you're not at all prepared to do is to run a firm, because you just don't know the full breadth of how to run a business. And I was incredibly fortunate in that I worked for IBM in 8 years, admittedly in their manufacturing division, but it was like every month there was a new training course. They did everything with a bottomless budget. Back in the 70s and early 80s, they were at the peak of their power in the marketplace. I mean, everybody knew IBM, and the probably the preeminent name in the IT world. And so they did everything well. Their personal development processes were fantastic. Their training was brilliant. And I got exposed to every different function in business, as well as encouraged to go out and do what I would call a poor man's MBA. I did 3 years doing a postgraduate diploma in management studies after my first degree. It was exactly the same syllabus as an MBA, but done over 3 years so I could carry on working. And that combination of that internal training in IBM and the external extra education, I think prepared me very well for running a business. And that's not the typical shape of somebody starting up a consulting firm. So I think that's the why. And so the symptoms are, you go into a business and you have all these people that look the same. They all look like they're consultants that are still in the old firms. There's virtually never a marketing function. If it is, it's something to do with the website or a few brochures. The concept of strategic marketing doesn't exist at all. If sales is recognized, it's called business development, and it's the job of the consultant to do. Nothing to do with any salesperson who may have some specific knowledge that the firm ought to really embrace. And I could go on with every one of the other functions. So you get a very, very lopsided organization that frankly isn't set up to grow. And often they stall 1 or 2 years in when their old business card runs out of old contacts that they used in the early days of the firm. And this is a really big problem. So a lot of what I've done personally, and Equiteq has done in recent years with its client base, is to try and broaden out that capability and try and get them to realize, and I still have arguments today with companies when I first meet them, that actually marketing has its place, for example, and that it's much better to be marketing-led rather than sales-led. Because if nothing else, if you're sales-led and reliant upon the rainmakers in the consulting business, you can be held to ransom, and that's not a comfortable feeling. It's happened to me in the past. People threatening to leave and take client with them, and so no, you have to disaggregate the task of getting new clients into its component elements, and the majority of that is to do with marketing. And every one of the businesses I've been involved in personally, beyond WCI and Equiteq into other firms I've founded, have been marketing led. And still to this day, I much prefer people to pick up the phone to me and say, hey, I've heard about you on this blog, on this whatever.
Yeah.
Right, can I come and talk to you?
As you know, and as my listeners will know, I fully share your belief in running a marketing firm specifically for consulting firms. I've had many of the conversations you've had. What you've explained throws up a paradox I want to dig into, but actually I think there's something interesting in what you've just said. It was a story actually you touched on just before we started, because anyone listening, you've had the career you had prior to Equiteq would probably be thinking, well, Paul, you built this successful firm, you knew tons of consulting entrepreneurs, and actually it would be easy. And I think it'd be fascinating if you could just share was how you approached that marketing challenge when you started Equiteq, because it felt almost so alien to what you've just described and what I think a lot of consulting entrepreneurs actually do. Yeah,
no, and I think what we did when we started Equiteq was very similar to what I did when I started WCI as well. So this was kind of well-trodden path, and it followed the principle of being more marketing-led than sales-led. All right, so we talk about Equiteq. As I said a moment ago, when I started Equiteq, it was off the back of bad experience of the investment banking M&A community. This feeling that there needed to be a challenger brand. There needed to be somebody who would do it differently. There needed to be somebody who wanted to understand about what the clients did, as opposed to viewing their business through the P&L and balance sheet. And I find the vast majority of our competitors still do that today. The first question they ask is, can I see your numbers? That they don't ask, what do you do and who do you do it for? And it's exactly the opposite here. We're really, really paranoid about what the company does, what they do. And so when I started, when we were consulting development, I was out there doing market research on what clients wanted to buy. And if I had an M&A capability, would they use it, right? Because I didn't. I was a consultant masquerading as an investment banker in the very early days. And whilst consultants can morph into many things, right? Investment banking is a very specific discipline, all right? And I learned some years later that it wasn't a good morph. And so you had to bring people in that had that trained background in investment banking and corporate finance. But back then I was out there trying to say to my client base, look, if I had this M&A capability, would you use it instead of the usual suspects? And pretty much everybody had the same bad experience. I mean, there's a funny story to make the point. When I was doing the beauty parades for my then clients who wanted to sell, I used to write the brief for the guys to come in and present. And part of that brief was always to give a case study example of a firm that looks very similar to my client. And you'd be surprised at some of the ones that came along. And the one that I remember the most was a company that presented the sale of a fish and chip shop as the closest thing that they'd done to a consulting firm. And didn't see.
So this was the advisors, the buyers. So this is the closest deal they've done to a.
This was the M&A advisors who were going to be selling my client, and then they didn't see a problem with that again, because if you look at the P&L and balance sheet of a chip shop, then you could be persuaded to think it's a consulting firm, right? And if you don't know what they do or why they do it, and it doesn't matter, does it? And just to make the point. So when I got the message overwhelmingly back from the client base, look, build that capability and we would use it. And then I took some of the money that I got from selling WCI and invested in building the investment banking capability. But the first thing that we did was to go out and build a community of potential future clients, and we used Top Consultants at the time as our route to market. Tony Restel is a business, as was back then. We knew that they had thousands of consultants in their community, and there would be some of those who worked in businesses that might want to sell at some point in the future. And so I wrote articles, I did blogs, I did seminars, and then later on webinars when they became popular, to create the demand for our services. And back then, we had people picking up the phone saying, that looks really interesting. We then ran seminars ourselves on how to build and sell your consulting business. About 2 or 3 times a year, we used to run those seminars, and we'd get 50, 60 people in a room, typically owners of young consulting firms who were en route to a future transaction. And that's how we built the business. If you go way back to the start of WCI, I did something pretty risky. I knew I needed to compete with the Coopers and Lybrand's and Price Waterhouses at the time, right, who were starting to sell JIT services, and I needed to make an impact, and there was just me. So because I'd worked with this guy, Richard Schoenberger, who'd written the book on JIT, I managed to persuade him to put his name to the business. So he became a director of JIT technology. Didn't ask for equity, and it was an academic and a seminar provider in the US, but had never run a seminar in the UK. So I remortgaged my house and raised £50,000 to put on a seminar.
Wow.
That was very risky back then.
That's hugely risky.
This was in the in the mid-80s. And that was a lot of money back then. It still is today, but it was a lot of money back then. Had nobody have turned up for that seminar, I'd have been bust. The business would have gone down the tubes. And fortunately, we managed to pull 500 people into a room, paying £500 a piece to come and listen to Richard Schoenberger. I topped and tailed him, got the reflected glory of his knowledge, and said, and here's how we'd done it in IBM, and here's how we'd done it in Thomson TV, and here's how I'd done it in this company. And that meant 500 people in the audience who became prospects who I could follow up with, right? And that seminar approach, I mean, back then you couldn't do a cheap and cheerful webinar. Yeah. Right? You had to pay 50,000 brochures to get people in a room. You had to pay up front for a hotel and pay cash up front. So it was a huge risk, but it really paid off big time. And after that, we probably ran another 20 seminars, right, of different types. And that's what drove the initial growth of WCI. And I got a big lesson from that.
There's so much in there, Paul, for listeners, and actually some really powerful things, like you say. I mean, that first point of, frankly, nowadays you don't need to remortgage your house. And actually, I think just to help people, as we were talking about before, this show gets anywhere from sort of high hundreds into the thousands of listeners. Yeah. And actually, the kit we're all sitting around today, you're probably looking the thick end of just shy of £1,000. Yeah. You don't need to spend that.
It's incredible, isn't it?
And like you say, that difference, but also, and it's a really interesting point. And do you know the guys over at Kubrick Group? I don't know if you've crossed paths with them.
No, not come across them.
So they're previous guests on the show.
Yes.
Run a very successful data consulting business, but they did exactly what you said. And I think it's something that so many people forget of. What you highlighted there with starting Equiteq is you actually asked your customers what they want and gave them that service. And I think so often I speak to businesses who, particularly in consulting, like you say, being consultants ourselves, we can say we think we're largely better than everyone else, and actually start by what is it we want to sell, and then finding buyers.
Well, you've opened another real can of worms there, right? Because if you recall, I mentioned this wheel, right? Yeah. And the top segment is called market proposition, and it's actually I'm washing dirty linen here, but it actually ended up there by accident, right? But I'm really glad it did, because I reckon we've made more money for our consulting clients by focusing on building a strong value proposition in their companies as part of their overall market proposition than almost anything else around this wheel. Because I can't believe to this day still how many companies I come across who don't ask clients what they want, who think they know what they want and try and sell them something they don't want to buy. And the other thing is that if what you're selling today will have to be different tomorrow. And often some of these are real fashion things, right? So I mentioned having to change the name JIT. Well, we didn't stop doing things to do with JIT in clients, but we just had to call it something different because it suddenly got a dirty name a few years in. And so we called it something different. Richard Schoenberger's next book was called World Class Manufacturing. And that's how we got onto World Class International. And we talked about creating the world class business. We were still doing waste elimination and total quality control and lead time reduction, all part of the sort of JIT stuff that we did in the early days. But the point is that we had to change what we were selling. We certainly had to change what we were marketing. And often there's a very big difference between what you market and what you sell. You market the latest thing to attract people into you, because every board of every client these days is exposed to so many different channels, and they want to be seen to be doing the latest idea. So when they're down the pub talking to their mates, or whether they're mixing with other CEOs in where they mix, they want to be saying, well, we're just doing this digital transformation in our business. You go in there today and say, actually, we've just brought in these process re-engineering consultants, and they say, wasn't that an 80s thing? Why are you doing that? The fact that the digital transformation consultants might be doing a hell of a lot of process re-engineering doesn't matter. The fact is that they've rebranded it and they're marketing it as something that's current. So asking your clients what they want to buy and then giving them that, making it look as unique as you possibly can by putting your own stamp on it. Why do we have this wheel? You could talk about some of these things in here as how do you build consultant loyalty? It doesn't sound very unique, but when it's part of the equity growth wheel, right, that's uniquely attached to Equiteq, then it's got a level of uniqueness that people want to buy into. They can't buy this from anywhere else, and so they'll come to you. And every firm has the ability to be able to do that.
And it's so true. I mean, taking my business, it was exactly the same path of enough. It was actually this show that started. You asked about how I started the show, but it was, for the business was the other way around. Of enough guests said something along the lines of, "This is a bit interesting." And like we have our digital marketing framework, and now. This, it's no secret, is what we have 100%, proprietary, special source. No, are there unique elements and a methodology we work through, just like you talked about your wheel? Definitely. But actually, can anyone create that model? I think so. And it's an interesting, and I know it's on your model, so I'd be intrigued in how you balance this. Is I think in our industry, part of the reason people don't market or sell in the way you've described is that sense around IP, and it might have changed, because I know you've been in the industry for, you have that full gamut, but I get the sense 20, 30 years ago, part of the cachet of consultants was you knew this secret thing that people don't now or didn't know. I'd be interested in how you counsel your clients on, I almost see that now is holding some people back, of almost they don't want to market, they don't want to do a webinar or like you say, a blog or a seminar, because they don't want to give away the gold, that golden goose.
You're absolutely right. And this is one of the big problems, I think, with the consulting community, is that they think exactly 180 degrees out from what they should be doing on this topic. They believe that by sharing their IP, that will bring in other competitors that will pick it up and try and use it, and will copy them, et cetera, and that'll be bad. It's been 100% my experience that the more of the IP you broadcast, the more business you get. And yes, there are people out there who do try and copy what we do, and there always has been. We did something similar in WCI with a wheel like this. This is not groundbreaking stuff. But the fact is that if your marketing is, we've got great clients and we've got great people, everybody's going to say that. No one's going to say we've got terrible people and our clients are lousy, are they? I mean, so you're all going to say your clients and your people are great. And so there's no differentiation in that. And I say to every one of our clients, and I don't care what their subject matter is in consulting these days, you can make what you do look completely unique. And you need to do that if you could compete on anything other than cost and price with the big guys. And if you compete on price, you're in a death spiral. You're going the wrong way. So you have to come up with something that has a level of uniqueness that your clients perceive they can't buy anywhere else. And as a business in Equiteq, we've never yet failed to create that level of uniqueness that drives clients into our client base. Right? So it's really important.
And because I'm sure someone listening will be thinking this, is on the one hand, you're saying you need IP to drive value.
Yes.
On the other hand, you're saying, and I'm just challenging to set you up for the answer here, is on the other hand, you're saying, actually, you should be giving your own words, giving away as much IP as you can. Particularly for the engineers like yourself. How do you balance that?
Okay, so Again, if you look back to this wheel, the intellectual property segment is diametrically opposite the market proposition. And again, that was by accident, but it's really good it happened that way. I wish I could say we designed it that way. But because if you can underpin your market proposition with solid intellectual property, i.e. your way of doing things, and this doesn't have to be a patent pending piece of software, right, or anything like that. It just has to be your way of doing things that you can talk about, and more importantly, have clients talk about the fact that you've worked that way. That underpins your market proposition. Then you're much more powerful. And if you look at it from an investor point of view, an investor is totally preoccupied with what happens to the people when they take the money. Do they stay or do they go?
And this is people being the whole firm, not just the founder.
Yeah. And if you accept that by the time a company sells, the majority situation is that the founder has spread some equity, and I'm a big believer in this. I mentioned the 11 millionaires in WCI when we sold. Right, I'm a big believer in spreading equity in people businesses, because in essence, as the founder, you want people to think like you as an entrepreneur, right, and building value in your business. And that's unlikely to happen unless you have some more people than you feeling entrepreneurial and believing that they're going to benefit from the shareholding in the firm. So, but from a buyer's perspective, whether you're a financial buyer or a trade buyer, you worry that if you suddenly put a few million quid in somebody's pocket, they're going to be less motivated to grow the firm, or they may actually disappear altogether. And what is it that mitigates against that? Well, part of what mitigates it is the business's ability to take what's in the head of those shareholders and turn it into intellectual property. So it doesn't matter necessarily that it's copyrighted, trademarked, and all the rest of it. What matters is it's locked down in the firm, and it's there to train up other people in the firm. It's there to use by anybody in the firm with the client base and continue to grow the organization. So it's not that we're going to take the IP and try and sell it. That's not what we're doing. And in fact, there's very bad track record of consulting firms taking intellectual property, turning it into hard IP, and then trying to sell it as a standalone entity. Lots of people try to do this with software, right? And it usually doesn't work because the DNA of a software firm is completely different to the DNA of a consulting firm. And unless you recognize that, usually it fails miserably. But it's not about that. It's not about trying to sell the IP independently. We never try and sell the IP off the back of this wheel. We use it, if you like, as sort of technology-enabled consulting. It underpins everything that we do and makes our service A, unique, and B, much more powerful, B, more validated, C, more repeatable. Yeah, and that's what you want. And if I disappeared off the face of the earth tomorrow and somebody bought Equiteq, this would still be there, this wheel. The software would still be there, the database would still be there, and 20 consultants out here who could use that and continue to use it with clients. So that's the main reason for building that IP. And IP exists in various forms. It's the IP that you use to consult with clients. It's the IP that you use to do with all your knowledge about your client base and your prospects. So your customer relationship management system, your pipeline of clients, your research and what have you. That's all IP that's of value to an investor, a buyer of your business. That's another form of IP. And then you've got all of the IP about how you run the business internally. So the three different forms of IP that we look to create in our clients before we think about putting them in front of an investor.
And it's interesting in there, actually, that difference in frame of that value is about sustainability and repeatability within that framework, as opposed to, I guess, confusing it almost with thought leadership, if you like.
No, it's not. It's thought leadership is great in that it might actually help attract clients to you, and that's part of the, if you like, the marketing mix, and an important part. But from an investor's perspective, right? So, Equiteq always views everything we do through the eyes of the investor. And we hope to build that discipline within all of the clients that we work with so that they do things through the eyes of a potential future investor. And it is about sustainability. Remember, you're taking a valuation from the buyer that's based at least a half on the future. So not surprisingly, the buyer's going to be completely preoccupied with sustainability of growth. They need to be convinced that this business is going to continue to grow. And they're going to assume, frankly, as a founder shareholder, whether you say anything to the contrary, they're going to assume you're going to go off to the beach. And they'll plan on that basis. They'll mitigate the fact that you're going to disappear. And but if you can show them that you've got this IP, if you've got this sales pipeline process, if you've got this customer relationship management system, if you've got a personal development process, and all these other things that show you are a robust firm that is built for sustainability and ongoing growth, then they'll accept your forecast. If you haven't got that, forget it. You just won't be interesting to them. They won't buy you, or not for a price you'd want to sell for.
It's another paradox, I guess, Paul, but there's something in everything you've just said. So I completely buy what you're saying. I guess there's an interesting challenge in that at that headline level, buyers or investors buy crudely a multiple of EBITDA. And there will be some people listening, you mentioned around consultants build businesses where BD is done by consultants, marketing is done by consultants.
Yes.
Actually, how do you square that paradox of we need a bigger EBITDA, which is a function of money left in the business, so profit, versus we need to build some of the equity wheel you just described? And actually, can it ever be the case, and I'll let you dig into this, you have a business that on paper makes less profit, but is either sold for or calculated as more valuable because it has those solid foundations?
Yes. Okay. So it is a paradox, and there are some real things that you need to do as a business that's building for a future transaction. And there are some things that your advisors will do if they've got their head screws on when it comes to presenting you to a buyer. They're two different things, right?
Okay.
So let me talk about the real things first. So if you're looking at building a business to sell, then there are examples of people who've done that in a few years. And you've had Don Morehouse on your program who did it in 5 years. And I was a part of that journey for 3 years of that 5 as a non-exec in the business. And I can tell you it's very rare to do it in 5 years. Dom and his team were incredibly talented and incredibly disciplined. And I think that has something to do with their special services background. They're the only business that I've ever come across who every quarter, when I went along to a board meeting, they'd met their target. And I didn't want to ask how, because I was afraid of the answer that I get. But they were an amazing business, and they built 20 million of value in 5 years, right? But that's very rare. So think 10 years as being more realistic. And you'll know, because I know you've pointed it out with me, right, that I've taken even longer in both my situations so far. I'll come back to that later if you want. But 10 years, I would say, is a minimum to get to the point where you built something of value. Now, part of that is something to do with scale. So businesses that get to, say, less than 15 or 20 million in sales are quite tough to sell. We proved that to ourselves in the early days of Equiteq, when a lot of what we were selling were businesses that were of that size, and whereas these days we're selling multi-hundred million businesses in the marketplace. And it's a lot easier to sell a 100 million turnover business than it is a 10 million turnover business. There are just more buyers that are interested. And so trying to get something of scale, and let's say more than 15 or 20 million, is probably something that someone should be aspiring to. If they're to guarantee a decent price and let's say a very liquid base of potential buyers to go to. Over that period of time, there ought to be time to invest in all the things I've talked about. If you haven't done that and you want to sell in a year's time, that's a problem. But if you know right up front that you need to build all of these other capabilities, it's not just about building the capabilities of your consultants to consult in the clients. It's about all of these other things if you're wanting to build a business. And you've got 10 years to do it, then that shouldn't be difficult. I mean, and it shouldn't have a big impact on the profitability of your business along the way, because there's a sequence of events. And I'll make a very simple point to make the point. There's no point at all in spending loads of money on marketing unless you've worked on the market proposition first.
Yeah.
Right?
Yeah.
Because you're wasting your time. You're trying to sell something. So your market propositions, we've got great clients and great people. Well, I can tell you that's bloody difficult to market. And so don't even try. Build your market proposition first. So there's a set sequence of events to go through that's part of our model of value creation in Equiteq that we use with clients. And that means that you don't have to do everything all at once. Therefore, you don't have to spend all the money at once, and you can feed that in along the way. One of the reasons we like to have a reasonable runway in advance of a sale is because we know not all of this is going to be in place. So if we've got 2 or 3 years to fix the problem, then we can still probably do it and still have decent profits shown in the business. And what do I mean by that? What looks good to us is at an EBITDA of 20%. So, and we've got many clients who produce more than 20% EBITDA. We've equally got an awful lot in the 10 to 20%. Less than 10% doesn't really cut the mustard, all right? There are not that many buyers who would be interested in firms that produce less than 10%, because you get a blip and it's gone. But over 20% is what we try and create in our client base. So those are the real things that you need to do. Now, one of the streams on preparing a company for sale, if you're someone like Equiteq on the M&A side, is, let's imagine a business comes to you, which happens all the time, fortunately, and somebody comes and says, "I'd like to sell my business tomorrow." And we say, "Okay, well, let's have a look at it." And we say, "Well, if you sell your business tomorrow, either A, it'll be difficult to sell it because of these reasons, or B, you'll only get this price for these reasons. Give us 6 to 12 months, and we'll fix some things that might double your value." And I'll give you one specific example. We sold a business in Helsinki in Finland a few years ago. And we bid to win this business. We didn't know this, one of the cases where we didn't know the business beforehand. We bid against some local guys in Finland to get it. And we told them how much we thought the business was worth. And that was half what everybody else had told them. So not surprisingly, we didn't get the gig. They went with a local guy who told them what they wanted to hear. And then 6 months later came back to us, having not got the sale, having got the prices that we said that they were worth. And then about another 6 months later, they said, "Can you help us? First of all, come in and value the business." So we did that. We said, "You're still worth what we said you were a year ago, but we can probably fix that." And I took something like 16 of their top managers, all of them shareholders in the firm, and we took them onto a little island off the coast of Finland for 2 days with the aim of saying, how do we improve profitability in this business over the next 6 months? And we put a plan together to double profits in 6 months. And as it happens, and part of that was shutting down some offices that they'd misspent on. Part of it was sacking some of their shareholders who kept their shares but took their cost out of the business in the knowledge that when the business sold, they'd get their money for their shares. Part of it was the 8 that were left became what they were in the beginning, which was salesmen and going out there and selling the services of their firm that they've forgotten how to do, and have got somewhat complacent because they'd misspent some money that they'd received from private equity some years earlier. And we knew what the private equity company needed to get from that business when it sold. And we knew it needed to be at least double the profits in order to do that. Well, to cut long story short, 6 months afterwards, we sold it for 3 times that because we tripled profits in 6 months. We tripled it in 6 months.
Wow.
And it's entirely possible to do that if you get the right amount of time. And, so improving profitability is something that we often get tasked with doing to get to the right price. And the other thing that a decent M&A firm will do in the short-term lead up to a sale is to look at the P&L statement and look at those things that are one-off spends that really shouldn't be amortized or depreciated in the year that it's been spent. Now, you do this generally for good tax purposes, that you will, from an accounting point of view, you'll depreciate all of that spend. But actually, if it relates to something that's going to give benefit over a 5-year period or 10-year period, there is a way of, accounting-wise, of bringing that out and adjusting the profits. And we look at everything we can to try and improve profitability. And we show an adjusted EBITDA to a buyer because we know that adjusted figure is what's going to set their thoughts. And then we'll have an argument about all the adjustments later. And interestingly, just psychologically on this, is that buyers will accept adjustments that sometimes they shouldn't do if they've emotionally committed to buy the firm. So if they've thought they're going to pay this price based on an adjusted EBITDA, if they then later, having fallen in love with the firm, suddenly find out that one of those adjustments isn't quite what they should accept, they might accept it. Because at the end of the day, a price is only what a qualified buyer will pay to a qualified seller. And it comes down to negotiation at the end of the day. And that can make a big difference to the eventual price that a seller gets.
If I'm honest, Paul, there's so many things in what you just said that we could dig into, and I'm sure we will. But one thing that struck me, and I know the Equiteq business model, like you said, has moved up the sort of the proverbial food chain, if you like, in terms of consulting firms. And you mentioned there around actually bigger businesses are easier to sell. There's two questions, and frankly, answer them in whichever order
Yeah.
makes most sense. Is the first thing to me says why, because I would almost assume that it's much easier to sell lots of little businesses to slightly bigger businesses. And then the other side of this coin, which is for anyone listening who maybe they're growing a firm and they're in the, I don't know, anything under that sort of 20 million that you highlight, or 10 to 20 million, actually what options do they have if for, call it time, for it preference, they don't want to scale to that size?
Yeah. Okay. So there's a different answer depending on what you mean by easy. So it is easier for a big firm to integrate a small firm rather than integrate a big firm. And there are lots of examples of big firm mergers that have failed because it is so difficult to do it. And part of the reason for that is that each big firm has its own DNA, its own culture, and one of them's going to prevail in the merger that they usually promoted as, whether it's an takeover, acquisition, or a proper merger. And that causes all sorts of problems. But if you're a, let's say, 50-man firm coming into a multi-hundreds of thousands firm, then it's very easy to integrate. But that's a different question as to how easy it is to buy it. And we're at the end of the buying and selling part of the spectrum rather than the integration piece. Right now, frankly, over the years, I've tried to sell integration services and nobody wants to buy them, which is indicative of the problem, right?
Okay.
Is that people don't recognize the issue of integration. And it is an issue often, but which people business is at the end of the day, right? And how you do it matters. Otherwise, you're going to lose a lot of the value that you bought in the first place. But at the buying and selling end, part of the problem is firms like ours need to make a fee to sell a business. And if you're selling a 2 million business or a 200 million business, you can make a bigger fee off a 200 million business, right, than a 2 million. I can tell you that the amount of man hours out here in amongst this team involved in selling a 200 million business is not that much different to selling a 2 million.
Really?
Yeah, it is. It's amazing. And part of the reason for that is that the 200 million one is likely to be much better organized. By definition, because they've got to 200 million, it shows that they've got many of the things we've talked about in place to have got there.
Yeah.
That's not true in a 2 million business. Now, the other thing is that if you look at it from a buyer's point of view, right, so we put out 2 reports every year that look at the state of the market. One of them is through the eyes of the buyers. And we go out and we interview 100 repeat buyers of consulting businesses, and we report on what sort of things they're looking for and what are the trends and how they view the market through the eyes of the buyer. And in every one of these buyers, there's something called a corporate development team. And it's the same issue for them as it is for us representing the seller. If they can buy a 100 million firm, it'll do what they call internally, it'll move the dial. It'll make a difference to the revenues, profits, and ability to serve the clients if they bought 100 million rather than bought a 2 million business. Yeah, even though that 2 million business may have a particular specialism that they really want to get and they haven't got, actually to engage the services of the corporate development team to buy a 2 million firm doesn't make an awful lot of sense when they could be buying a 100 million business. And I can remember years ago when we were selling businesses that were sub 10 million in sales. We got partway through a sale to a UK PLC who was the buyer. And we just got a phone call one day saying, sorry, we love this company, but we can't afford the time to do it any longer. We've got this big opportunity in India for this massive firm, and all the team's going over to India to buy this team. Sorry, you'll have to tell your client that we can't buy them now. Well, if you're on the receiving end of that message, you get pretty hacked off. And so size is an issue when it comes to buying and selling firms. And that inevitably drives organizations like mine up the value curve to sell bigger and bigger firms. And you're pushing at an open door when it comes to the buyer set because they want to buy bigger firms anyway. And they'll only buy a smaller firm if they can't buy what they want in scale.
Yeah.
So a lot of the real specialist small firms do sell, but it's not because the buyer wanted to buy that scale. It's because they couldn't find what these guys do in a bigger firm. So my advice is if you want to sell a smaller firm, is first of all, and this may require hindsight, is you need to be on a real hot specialism. So if you were a bunch of data analysts or you were on digital something, or cybersecurity or any one of the sort of really hot topics of the day that we've got buyers chomping at the bit wanting to acquire, there are just not that many big firms out there that have developed that capability as yet to sell. So we have been selling smaller firms of that type, but because they're in great demand, the price for them can often, sort of be higher than you might think that the size would suggest. But that's with hindsight. If you're sat there doing something that everybody else is doing and you're turning over less than 5 million today, you're not going to get much money up front for your business. You may be of interest to a buyer, but they'll see you more as a big recruit. They'll see you as capacity rather than new capability. And they'll want to buy you almost like recruiting you.
Yeah.
Right? So they won't want to give you much money up front. And you will get the rest of the money. So they might value, let's say they value at one-time sales, which is, is fine. It's for a small firm, one-time sales is really good. But you might get it over the next 5 years out of your own profits, which you probably would have got anyway.
Yeah.
And so it's debatable. When you do the business case on selling a small firm from the perspective of the senior shareholders, the founder senior shareholders, on what financially they'd be better off doing, either selling or keeping going, you usually come up with the answer they should be better keeping on going.
It raises an interesting question, and this might also tee up for you mentioned something earlier that I wanted to come back to, and this might be the point of almost, well, there's two things. Is one, you mentioned right at the start around that sort of finance, that VC model of almost the VC model lets the founding director or the founders cash out while incentivizing the management layer below. And you mentioned around spread equity and incentivizing the team of almost, for those people listening who maybe they've been doing their business for, and I know you said if it's flatlined, you're probably not selling regardless, but where you've got maybe that junior management layer coming in who want to buy, you've got a senior founding team who want to cash out. Is that somewhere that, and it might not be the sort of deals you do, but in the market, is that where that VC money can help, people in that sort of sub 5? Yeah.
So the VC market is not very active in the consulting sector. And I mean venture capital as opposed to private equity. So venture capital tends to get involved in early stage businesses, often where there's a tech content or where there's something that there's usually some product associated with it. And so far, there's not been many examples of them getting involved in consulting. Private equity, I could probably think of only one or two companies in the London market who would be interested in a firm of that size. Yeah. So it tends to be, I'd say, a bare minimum of sort of 10 or 15 million or above that would interest them. Now, there are, like all of these things, there's exceptions to the rule. I've mentioned one exception already, which is if you've got something really hot.
Yeah.
Right. The other exception is if they've already invested in what they call a platform company. So they've done the 20 million or the 50 million investment. And that firm wants to grow inorganically by making acquisitions. And there are private equity companies out there that bill themselves as buy and build specialists. So they'll make a big investment in a platform company, they call it. And then they'll put money to one side that's usually agreed up front with the platform company's owners to then go and make further acquisitions. And this is a great thing to do if you become that platform company. So you've got third-party money to be able to go and spend on acquiring new capability or new capacity. And that might suit the smaller company. Now, again, you might not get a great deal structure. So you may get paid over a period of time. It's not going to be at the 10 times EBITDA end of the spectrum. It's going to be closer to the 3 to 5 times EBITDA, probably. But it's a way of selling your business. The other situation is, and we've been involved in some of these, is where debt is used or future profits to restructure shareholding. Now, so you can imagine, let's say that there is a founder shareholder who's ceased to be operational in the business and maybe has already spread a lot of the shares in amongst the people, all right, but wants to cash out now. The business doesn't want to sell lock, stock and barrel to a trade. It's not the right stage for whatever reason. They don't even really want to bring private equity money in, all right? They don't think that's appropriate, but they want to find a way of cashing out the founder. And sometimes you can persuade a bank or a debt provider, which will have similar characteristics to a bank, right, but probably charge you more interest, to bring money in to buy out that shareholder. And you may end up with the debt on the balance sheet that then the business pays down over a period of time. Or the other option is that, and for some, we've seen this happen numerous times, right? And for some founder sellers, they're quite comfortable with this. And this might be where they've gone to be a non-exec in the business. They're not involved day to day, but at least they're keeping in touch with what's going on in the business. And they say, buy me out of future profits. So I'll sell my shares. I'll agree a price now, and I'll receive the consideration for my shares over a period of time out of excess profits in the company. And that can be another way of doing it. So there are many different ways to skin this cat. And I think the most important thing for, if you're an owner of a business today, is just to be aware of all of the different flavors there are out there of realizing share value and when's appropriate in what situation. And of course, that's the type of thing that firms like Equiteq do, is to just make you aware of all those different options and then give you options, real options, in terms of finding either sources of debt or sources of equity finance through the trade or through the financial investment community.
I've made notes of that, and there's so many in there that this world seems like one that you don't know about until you know about, and there's so many different avenues to...
And there's absolutely no reason why, if you are the founder and owner of a consulting business, should you ever know anything about this. I didn't, so I can really relate to this. When we were selling WCI, I knew nothing about this. And frankly, because we had lousy advisors, and also because I stupidly allowed my partner in crime at the time in the business to take the responsibility for running the sale internally, when I was running the business and making sure that it didn't die, because we haven't talked about that. But the biggest single thing that kills a sale is if the business comes off its growth path during the course of a sale. And that often happens if the management in the business suddenly get in their head that they've sold the business, the money's in the bank, and now they're thinking of spending it, right? And so they get distracted from running the firm. And if you come off your growth trajectory, you'll kill any sale process. So,
and how long is a sale? Just because I don't know. How long does that how long is that? Sorry.
6 months to 9 months.
Okay.
That sort of order. You can do it in less. You can certainly do it in less if it's a financial investor, because they're just set up to buy, whereas most trade buyers are not as efficient, right, as them, all right? So you can do it in less than 6 months. But if you think 6 to 9 months, you'll not be far off. And obviously that's a long time for things to go wrong. Yeah. And if suddenly your management, who are normally, nose to the grindstone out there selling, new projects to clients, suddenly get distracted for whatever reason, either because they're too much involved in the sale process or because they're already spending the money, then things can go terribly wrong very quickly, all right? And you really don't want that to happen. But I allowed my old partner in crime who was a sort of, if you like, sort of chairman of the business, right? And I was CEO running the firm, to be involved in selling the business. And of course, his motivation was to just get it sold as soon as possible, because he was off to the beach and I was the poor so-and-so that had to continue to run the business. And we did a terrible deal with private equity back then, which, it was just difficult. But these days you don't have to do that. It's there are very good deals to be done with that community.
And if you can't talk about it, stop me and we'll move on.
Sure.
But I think this is a brilliant point to talk about your latest project, and both, and I'll let you introduce it as you choose. But I think both what we've just discussed and almost the shining that light on the technical part. But I guess there's an equally important and almost often overlooked part of actually business is only one part of your life. And actually, like you mentioned, if the journey is not, if Dom is the exception of 5 and the norm is 10, 15, 20, whatever it might be, actually how you make that work as a broader life.
Yeah. I will. It's a really important point, and I'm glad you raised it. And frankly, I admire Dom for doing what he did, because I know one of the big motivations was his family. He got a pass out for 5 years, basically. And he was absolutely right to do that. But most people don't do that. And I have not done that. It's fair to say that over the last 30, 35 years, when I've been running my own businesses, it has preoccupied me to, the extent that I haven't had time for personal life. And I've had divorces, I've had family splits and all sorts of things, right, which I'm not proud of. And one of my motivations to work on my current project is to try and make sure other people don't go that path. So I'm writing a book, as you do when you get to my age. Part of that is motivated by, either that giant trevally or drag me out to sea, or senile dementia will set in soon, all right? But there's still a lot in the head that I need to get out on paper for hopefully the benefit of others. And the working title of the book today, and there's been several, but the working title today is How to Build a $100 Million Consulting Business and Survive to Tell the Tale. And with the emphasis on survive there. And so it's intended to, early stages in it, it's hopefully something that should come out next year, but it will go through all of the lessons learned about building a firm, a consulting business. And it will include all of the stuff I've touched on here that is part of Equiteq's trade of helping companies to grow. But it will also cover how you get a balanced life at the same time. So hopefully the same things don't happen to you that happen to me. And it is possible entirely to do that. And part of it is understanding that it can't be you that takes the responsibility for everything. It can't be you that does everything. One of the problems, I think, particularly in the consulting sector, is that because you start these businesses with a mindset that you're this great consultant that can do everything, and whether it's marketing, sales, product development, whatever it might be, you feel that you can do it, and therefore you do it, and you don't give responsibility to others, right? So I think the average consultant is not good at delegating, is not good at bringing people into the company to share the load, is not good at sharing equity in the organization and making other people think like entrepreneurs alongside them, and he's certainly not good at sharing the P&L. And it took me quite a long time to realize that one of the tricks to scaling a business is to have somebody who thinks exactly the same way as you about part of your business. Not all of it, but part of your business. And if you can get 10 of those, thinking about, as an entrepreneur, a tenth each of your business, then suddenly you take a massive load off you. And I took far too long to realize this in WCI. It's one of the reasons why it took 16 or 17 years to get to a business that we got to that 100 million. And I'm sure it could have been done sooner, right? Had we've realized that earlier, or had I have realized that earlier. And I hope in Equiteq, even though, I'm still in here some sort of 14 or 15 years later, I'm kind of semi-retired now. I spend as much time fishing as I do in the business.
Well, it's worth showing how many days you fished last year.
Yeah, no, I'm kind of semi-embarrassed about it, but I actually fished 100 days last year, and but don't tell any of my colleagues. And I handed over the reins of CEO to a guy called David Jorgensen, who's an American who works out of our New York office, some 3 years ago now. And that was exactly the right thing to do at the right time. And that was just not just an age-related matter. It was time that somebody with a pure investment banking background, which David has, started to take over the business. And we've still got a very healthy mix of consulting and investment banking in the business, but that side of it needed to take preeminence. And David came from an investment banking background and is doing a fantastic job. But it's meant that I backed off to chairman, and I formally have to come along to quarterly board meetings. And if I come into the office in between those, people say I'm interfering, all right? But it's that enables me now to get the right balance, and knowing when to back off, knowing when to share different parts of the business with other people is really, really important. And I did get an early message in my late 20s, early 30s from a friend of mine whose father had told him this, and he said that to do what you do, and this guy was a lawyer and I was an aspiring consultant at the time. And he said, to do what you do, you need to have the confidence to be able to go out there and sell to big corporates and, do big projects and all the rest of it. And so you'll never believe that anybody else is going to be as good as you. That's just the nature of the beast. He said, but if you can find two people who are 3/4 as good as you each, that's 150% of your capacity. And that was kind of a penny that dropped. And that dropped from the point of view of growing the business and scaling the consulting side and bringing in other functional support. What the penny didn't drop, however, in that you can take complete parts of your organization from a profit and loss point of view and say, right, you have responsibility for that now, Mr. X, Miss X, right, whatever. And that's exactly how you should scale a big organization, right, is to create those people who have part of your P&L and are totally responsible for growing that.
And this might either be how you or
Yes.
how you will write in the book, but how did you get comfortable with that? Was it, like you said, that piece of advice, that penny drop moment, and either it was or after that, what were the steps that let you almost let the reins off a little to let people have that freedom and give you that capacity?
So if you take WCI, it took us 10 years to get to 5 million turnover, which is a hell of a long time. It then took 5 years to get to 50 million. Now, the first 5 are actually more difficult than the next 45, right? There's no doubt. Fine-tuning your market proposition and getting the business model right that you can then scale is tough. And every new market you go into, you have to start that again. So you might say, well, having done that in WCI, why did it take the same 5 years to get to 5 million in Equiteq? Because it did. But it's because it's a completely different business, right? And, frankly, with hindsight, it would have been so much easier to have created another WCI and we'd have done it much quicker. But that's not as challenging, is it? And there's a certain masochistic streak in me, and I suspect a lot of others, right? They say, well, if you've done it once, you don't want to do it again. So doing it in a different business, in a different domain like M&A, it took that same 5 years. But in WCI, in that next 5 to 50, it was an awful lot about sharing control on different parts of the business. And you do it by experimentation. You see what works. You kind of know in your heart of hearts what should work, but until you experiment, you don't really know. And it's like with compensation. I've experimented. I did a lot of experimentation in WCI on different compensation schemes, on how you motivate teamwork and individual performance. I can remember 1 3-year period where we changed the bonus scheme between individual performance reward and team performance award, between 25, 75, 75, 25, 50, 50, to see which worked best. And, in every consulting firm, everybody has their own spreadsheet on personal compensation. They all know how they get driven, and they measure it, every day, it seems. And when you change the scheme, behaviors change overnight. And I found, for example, in that case, that the 50-50 team and individual worked the best. You got bad behavior if it was 25-75 either way between personal and team.
Really? Why was that?
Because if you're the type of person that's totally motivated by team, what tends to happen is that the poorer individual performers back off because they know that they're being supported by other people. And the really high performers resent the fact that there are people who have backed off, and so it negatively impacts on them as well. And it's the same if you have it the other way around. If it's say 75% individual performance, then people are not very teamy, and you get bad behavior the other way. You get internal competition going on between people, and that can be destructive in a business where there should be a solid element of team. So we experimented with that, and we ended up with a 50-50. And it's the same, if there's no writing. I mean, I challenge anybody, maybe other than David Maister's book on how to build a professional service firm, to go out there and find books that tell you how you should do this. They just don't exist. And there's another reason why I'm writing this book. I mean, there is nothing really in the marketplace still to this day that helps you at that real detailed level make those types of decisions. And I hope the book will put that right.
Yeah, and it's something that, and this might be a later in life myself, of one day I want to release this podcast as a book for exactly the same reason. There is, for an industry that's full of very bright people doing really fascinating things, it's amazing how little literature or industry knowledge there is written down, like you say. And this again might be preempting the book, because you touched there around, it was that the 5 and then scaling to 50 was very quick. For those who are earlier in the journey and want to almost start living by those lessons, almost, how can people start to hand over responsibility in the early days when potentially they don't have that, really healthy cash flow to bring in a couple of partner level colleagues? How can people do that? Yeah.
So you might be familiar with a terminology that doesn't have great currency these days, because it's kind of slightly disparaging, I think. But the analogy of grinders, minders, and finders. Yeah, you come across that?
So, and I'm sure he won't mind me saying this, I was having a conversation with Dom only a couple of weeks ago, and it was the first time I heard that.
Yeah,
so
he probably got that from me. And I found it very useful to help answer this particular question. All right, so grinders are the more junior people who are out there working on the projects. They've got a particular work stream to work on, deliverables to do, right, and that's the majority of the consultants who are out on an engagement. Then the minders are the project managers, whose job it is to make sure that the project delivers to the client's requirements, and they may also be managing the client. So different types of minders, and then the finders, as the name suggests, are the guys who go out there and find new work. It potentially might be new work in a client, the sort of farmer mentality of selling within an existing client, or it could be the hunter type of salesman who's out there looking for new clients, right? Those are the finders. And it's a fact, rightly or wrongly, and you can debate this if you get philosophical about it, but it's those who've got a selling capability who tend to rise up the consulting hierarchy and become the future partners, their ability to be able to go out there and win that new big client, that new big contract. And so if you see grinders, minders, and finders like a hierarchy, then when you're looking to build your organization, if you've decided that you're going to set up this business, all right, you may be an employee today, or you're of a bigger firm, or you're an independent out there, you probably have got some confidence that you've got some selling ability. You'd probably be a bit mad to go and decide to do this if you didn't feel that you had some ability to go and persuade a client to take your services on. So you'll probably start off by selling your own time, and bringing some cash in. And the first employee that I brought into WCI was somebody who would replace me in IBM. So remember, I was their just-in-time program manager in IBM, and then left to join A.T. Kearney and then set up WCI off the back of that. Well, IBM carried on. When I left, it didn't stop, right? And they appointed new JIT program managers who obviously started to get the same sort of training that I got in IBM. So I thought that would be a great ground to go and poach some people from. And they hated me for it when I'd done 2 or 3 of these. But I recruited, my first person came out of IBM who'd got the same training as me in just in time. And they went straight out onto projects. So instead of me just selling me, and I remember working out how many days of my time I'd have to bill extra to pay for them if they were no good. If they couldn't bill from day one, how much of my time extra would I have to sell to effectively fund it? And it wasn't a lot, because at the time, we may have been charging out, let's say, 1,000 a day, and let's say I was paying that person 50,000 a year. That's 50 days. Over the course of, a month, right? That's only an extra 3 or 4 days that I would need to bill myself to pay for that person. And that was my mentality to start off with, all right? And then when you come to the next one, where you've hopefully got 2 of you by then who are billing to be able to fund the next person. And I've never yet found in a consulting business that you ever need to go borrow money to grow organically. You should be able to fund it out of cash flow. So if your business model is right, that you're making sufficient profit, the cash that you're making off the back of, let's say, 20 odd percent EBITDA should be able to produce enough cash to be able to fund the next person, and then the next person, and the next person. And then you're bringing them in typically into that grinding position. They may be then moving up into the managing position. And all the time, they're pushing you into a position where you're spending more and more of your time finding and winning new clients. And then eventually, you find people who come up through minding to finding. And that means you're then into practice development. Your job becomes more of a marketing job, more of a building the practice, rather than being involved in the business day to day. You're working more on the business, on trying to grow it. And that's where you need to get yourself to in building a consulting business, or in any business for that matter. The only variant to that is that you may start off with some other people. So it's not unusual for 2 or 3 people to break away. And then it's a question of working out in amongst you, have the debate over shares and things like that to start off, but then work out in amongst you what the skill sets are and how you fit in that minding, grinding, finding bit, right? And make sure you play to the right skill sets to get the business off the ground. And it could be that one of you is really great at managing clients and managing projects and should do that every day and not go anywhere near selling. Another one of you is great at going out and winning new clients, where you should do that all day to start off with, just to get that momentum. Because if you don't grow fast in the first 1 or 2 years, you run out of steam. And so, not growing by 20 or 30 or 40%, this is doubling and trebling and quadrupling, right, in those first few years. You need that momentum growing quite quickly.
And I'm assuming because you mentioned there around if you've got multiple founders, actually, you can do almost that skills analysis. Yeah. I'm assuming to your point around how to bring people in to take those, those finding, minding, grinding roles is almost, you can do that yourself, or if you're co-founders as well, it's then just filling. Am I right? It's filling those gaps with the right people.
Yeah, it is. And and very soon, once you start to get to a handful of people or more, you then need to start thinking about the functional support, and people leave that again far too late. There's one business out there that is at the moment still in the marketplace that has failed to sell twice, once with us and once with somebody else, because they never took the advice about bringing a decent finance director into the business. And now they're a very big business and still don't have a decent finance director. And so having good functional experts alongside the business at a certain point is really important. And if you can't afford that decent finance director full time, then there are lots of part-time finance directors out there you can bring in for a day a week or a day a fortnight to start off with. You just need that different skill set alongside you to make sure that you're not myopic and viewing life, everything as a consultant, because you'll do that otherwise. And of course, there is the other option that you can play in the early days, which is to tap into the independent consultant market to help build some capacity. And surprisingly, when it comes to sell your business, so long as it's not 80% of your consulting capability is contractors, you'll still get value if it's down at the sort of 20 or 30%. And so from a time-wise point of view, in the early days, if you want to mitigate some of the risk of employing people, you can start to bring some people in as contractors. But bear in mind that when you do that, you only get value from them when you're paying them and they're out billing with clients. The great thing about an employee, if you're utilizing them to the level of sort of 65, 70% on average, you've still got that 25, 30% left that can be involved in helping grow the business with you. And you don't get that with contractors. With the best will in the world, they're paid, by the hour, by the day people. And when they're not with clients earning, they're not going to be helping you grow your business, whereas employees will. And that's something to take into account.
I don't want to preempt the book too much. So probably the last one, but I'm interested in, and I'll jump on something you said, and you could tell me if it's the most important bit, but you mentioned around how you personally, you struggle to switch off, and growing my own business, I completely, we're much earlier on in the journey, but I completely understand where that comes from. And I'm sure other listeners do. And actually even those who aren't running their own businesses, we've talked a lot about the entrepreneurial side, but I'm sure you remember as well as I do, when you're in a consulting firm, it can be just as intense to be climbing those ranks. Actually, what would your advice be, or how did you find work for you to help you switch off and start to, I guess, take that step back to the point where you can now fish for those 100 days a year?
I think it comes down to really sharing responsibility. And this is not just about bringing employees in to grind or mind. It's having people in the organization that you can look to and say, our task this year is to get from 8 million to 10 million. Of that, your responsibility is 4 million of that, which is some existing client work, some growth in existing clients, some new client work. You are totally responsible for doing that. And you'll be held to account on that. You'll be measured against that. You'll be compensated, and you'll be rewarded, right, in share value, et cetera, and to do that. It's that real sharing of responsibility in a group of what should be seen as peers in the organization. And if all of that feels as if it's falling on your head all the time, that's the problem, that you can never stop thinking about it to the exclusion of everything else, including your personal life. And I'm 65 now, and it's you can kind of look back on your life and say, would you have done things differently? And I absolutely would have done things differently from that balanced life point of view. I now know what to do. It's a bit late now. Kind of that side of my life is kind of over, right? But I do believe it's possible to do it, and I'll hopefully share some of those lessons learned in the book, and hopefully many of your listeners who are a lot younger than I will take note and hopefully get a better balance.
Well, and I know I said this before, and I'll echo it again. Obviously, being in that position now, I'm looking forward to that book. And so please do let me know. And the podcast will still be running by the time the book launches. I'd love to help you, promote that as well. And actually, that brings us quite nicely onto the last questions for today, because we've covered a whole ton. And thank you very much for your time on this, Paul. And so the first one actually is about books.
Yes.
And so these are questions it's worth saying I ask all of my guests.
Yeah.
And the first one, and the answer, I won't let you say it's the book you're about to write here. So the question is to get your take on really the book or books that you find yourself, and maybe take the firms that you speak to throughout your time with Equiteq, is what is that book or books that you found yourself giving to people or recommending to them most often?
It's a really good question. And when you mentioned it before, I was really racking my brain on this one, all right? Because back in WCI days, there were one or two absolute landmark texts that we effectively eventually became distributors of, not because we wanted to make money out of selling books, but just because they were so good. And one of them is called The Goal by Eli Goldratt. And he was an Israeli expert in issues to do with what he called bottleneck management. And the great thing about the book is it was written as a story about this plant manager who had this problem, and he had all sorts of personal problems, and he had this problem at work. And it's a wonderful story, and it had a massive impact on the way I saw the world of manufacturing. And the second one was that my old mentor, consultant, and then co-director in JIT was Dr. Richard Schoenberger, which was the Japanese manufacturing techniques, nine lessons in simplicity. He wrote lots of books after that, but I think his first book was the landmark text, right, that really explained to the Western world, why it was the Japanese were decimating our big manufacturers. Fantastic book, right? It changed the course of my career and kind of never looked back from there. In Equiteq, it's been really tough to find stuff that, you've wanted to recommend, right? I mean, we've got a few texts, but there's none that I would want to pull out as ones that, we would give time and time again. It's the reason I wrote this tips guide, it's going back now, so almost 10 years, which has been very useful to clients. But there's not much out there. I mentioned a moment ago, David Maister's managing the professional service firm, and he's had some others after that. And there's lots of content in there, but it's difficult to get through. It's not written in a very accessible way. Ex-McKinsey consultant, and it's really quite detailed. But it's fantastic if you have got the time to get through it. But there isn't much out there. These days, I tend to read stuff that's not associated with, right? So in recent times, the Sapiens trilogy, and Homo Deus and what have you, has been my reading matter, right? And I find that fascinating. And I've just bought Bill Bryson's new book, The Body, and which I think is going to be a great read. But there's nothing I could really tell you about that relates to the world of M&A. There's just not much out there.
Well, and I know I said you weren't allowed to use it as an answer, but obviously while you're writing the book, and a legacy like that of David Maister's would be a brilliant thing to leave the industry, because it is. It's amazing how, and it was actually a book Dom, and
yes.
Again, Dom may have got it from yourself, but that book, I mean, was it now 20, 30
It's been around for years.
And actually, it's amazing. Nothing has surpassed it.
No. I think
then.
Part of it is the point you raised earlier about this lack of willingness of sharing your knowledge. Yeah. And that comes back to a lack of understanding of marketing.
Yeah, well, and I don't usually open the question up, but it struck me, and people will have to listen to this bit to find it. But you made the point there that actually that tips guide is 10 years old, and you're still giving it to clients now, and the value there is still there. And I think that's almost to your point earlier around, you sometimes need to rebadge things, but actually that thought up front in proposition development can last your firm its proverbial lifetime.
Absolutely. Yeah, definitely.
And so the very last question, and again, Paul, this might be a chance to recap, it might be a chance to add, but I'll let you decide. And this one is, you have three people in front of you, and you can give one piece of advice to each. And I know you've seen the questions in advance, so I'm doing this more for the listeners' benefit than yours. One of them is just starting out, that 21-year-old, that graduate. One is, I'd say, manager level. So they've been in consulting long enough to understand it, to have cut their teeth, and it's almost that, okay, where do I go next? And then the final one is somebody who is approaching that partner level, and that could either be someone who is very much going to take a partnership position in a traditional consulting firm, or someone who's thinking, well, you made the reference earlier, someone who's thinking, well, maybe actually, do I want to be a partner, or do I want to go out on my own? And as I said, the question is quite simply, what one piece of advice would you give to each of those three people?
One of the great things about being a pensioner now is that it doesn't matter what you say. Because, if people don't like it, they can say, oh, he's old now, and it doesn't really matter. What does it matter? So I'm going to give you a somewhat heretical answer. So to the young person who's just starting, go into one of the bigger firms and learn as much as you can. They're fantastic places for learning stuff. If you want to learn how to be a consultant, how to develop a certain subject matter to the point where you're seen as an expert, it's a wonderful industry to get involved in client businesses at a much, much younger age than you would normally do by going into the normal management route that I did back in Lucas and then IBM. So I think it's a fantastic place to start your career. So go do it, right? See where it goes. To the one who's, maybe the future version of that person, all right, but who is now, they've done a few years of that, right? They've learned a lot. If they're in one of the big firms, I think you've got some options, and they're all good options, right? So there are some people who just love the environment that they're in. It's a cosseted environment. There's loads of resources around them. They've got a fantastic business card. And there's that, sort of promise that one day they might be a partner and there are all of these spoils to come. I would ask you to look at the organization structure and just see the ratios, right, between numbers of partners and numbers further down the organization, and then search your heart as to whether you're going to be one of those future partners, right, in looking at your options. But I think the options are to go and join another boutique firm. So if you don't stay where you are, you'll get exposed to much greater responsibility sooner in a boutique firm. And, pick one of the better ones, right, that's been around a while, that's not just been there for two or 3 years. So, your alma mater at Beringer or something like that. But pick one of the mid-sized firms, and your potential for progression and for earnings and responsibility and challenge is probably greater in moving out into one of those firms. And frankly, if it doesn't work out for whatever reason, you can probably go back to where you were before. So I would look at that potential. I'd also look at the world of financial services and particularly investment banking. Some years ago, there was a graph on the front page of City AM, which is the local free mag in the streets of London that's out every day, that had a graph of income versus age comparing the consulting industry with the investment banking industry. And it was a fascinating graph. And what it said is that from age 21 to 25, if I remember rightly, you get better income by working in consulting than you would in investment banking. But at about the age of 25, 26, the graph crossed over, and the consulting one continued linearly forward. The investment banking one went exponential. And so at the age of 30, you might be earning 2 or 3 times what you would earn in consulting. And it caused quite a furore in the city at the time. And lots of people didn't believe it, right? But I believe it to be true, having run a consulting business and now run a very expensive M&A business, right? The expectation of my 30-odd-year-olds out here is far greater from an income point of view than they ever would have been if they'd have been working in WCI of old. So I think that's a great place to have good income and very, very challenging work, all right? And so firms like Equiteq, all right, or even some of the bigger investment bankers are another option to consider. The one who's just about to become partner is an interesting one.
Go on.
There's no doubt the life of the partner can be great. I think if you can... And I'm not talking from personal experience here, right? Now, I know lots of partners of the big consulting firms, right? So some of them are friends, and so I know their life. And I think if you are good at managing in a big corporate environment, you're good at managing the politics in a big corporate environment, you are good at protecting your back and supporting you and your team in amongst your other very competitive partners, then I think it can be a great existence, and you can have not only a very good earning life, but the way in which you earn is very different to the person who decides to build their own business and then potentially sell. And I've often looked at this and compared and contrasted the two, because the person who's in the partnership is earning more each year along the way compared usually to the person who's in running their own business. The difference is obviously at the end, the person is able to sell their business if they're running a business. But then if you look with hindsight, let's say it's a 10-year period, and look at the amount a partner would have earned over that 10 years versus the amount of income an owner would have earned, plus the amount that they receive to their firm, unless they do a really good job of building the firm and get the 100 million or so at the end, then often you find the partner has earned more over that period of time. And also it's been delivered each year rather than waiting for it at the end. And that's also has a very different psychology about your life. And I think the owner's life often drives some of the problems, right, of being totally focused on what you're doing as opposed to the partnership life. So I have found in the past in WCI that the person who's about to become a partner, you can persuade them to come and join you. Once they've become a partner, it's very difficult. Yeah, and they've seen, the potential fortune that's on the horizon. But the ones who might become a partner, who should become a partner next in terms of their progress, but might not become a partner, there's an opportunity to go. So they still have an opportunity, I think, to move out into a boutique firm at a senior level. But probably most of them are going to continue to be the partner where they are, because it's the easier route. It's the less risk route. And who knows, it might be the best route for them.
Well, and Paul, I think that is a fantastic place to leave us. I'm holding myself back because I would love to dig into that, but we don't have time. And I think that will hold for the book, and I'm sure you'll dig into exactly that decision in there, because it's a fascinating one. And so the last piece, so firstly, thank you so much for this. But for anyone listening who wants to find out more about yourself or wants to find out more about Equiteq, either to, like you've just said, potentially look to change career, or they're a business owner themselves looking for support with sale, where would you point them to? Where can they get in touch?
My Equiteq email, right, is the best, right?
Okay.
And that's very simple. It's paul.collins@equiteq.com. For those of you who don't know, because people get this wrong all the time, Equiteq spelt with a Q on the end, not a C. So Equiteq with a Q on the end. So paul.collins@equiteq.com.
Fantastic, Paul. Well, I will put links to both. I'll give your email in the show notes. I'll put a link to the website, and anyone can get in touch. So all that's left to say is, well, thank you so much, and all the best for the rest of your week.
Thank you very much. I've really enjoyed the conversation, and I hope it's of some benefit to your listeners.
Thanks a lot, Paul. I hope you enjoyed today's episode of the Climb in Consulting podcast. If you did, I would be very grateful if you could leave a review on iTunes, Stitcher, or your podcast platform of choice, whichever one you may be using. And please also share this with anyone that you think could benefit from hearing today's interview. If you want to get in touch or give me any feedback about the podcast, please feel free to drop me an email. It's nick@climbinconsulting.com, and I look forward to hearing from you.